Hi guys, it's Grayson here. So for those that don't know me, I'm a stock investor and I have experience working with an investment firm. So before you start to picking and invest your own individual stocks, a very powerful way to determine the stock is it undervalued or overpriced is actually by interpreting and understands all the financial ratios the firm have. Actually, nowadays you can get the financial ratios from your broker or even from online sites like Yahoo Finance, like Bloomberg, etc. And today I'm gonna bring you to the 5 most used ratio that I use to interpret the stocks, and hopefully you can get something on it. So the first ratio, we have price to earning ratio, or we call it the PE ratio. The PE ratio is probably the world's most famous financial ratio and the most used one amongst the investor because it's one of the quickest way to find out or determine how cheap or expensive the stock is. The best way to put this is how much you are willing to pay for every $1 profit the company generates. So to find out the PE ratio, what you need is a income statement and the company latest stocks price. And the formula to calculate the PE ratio is price per share divided by earning per share. And the second one, we have debt to equity ratios. The debt to equity ratios measures the relationship between the amount of capital that has been borrowed, for example like debt, and the amount of capital that are contributed by the shareholder or investor through equity. To put it in a simple way, most of the cases, if the company debt to equity ratio increases, it will become more risky to the investor and shareholder because once if the company are unable to meet the debt obligations, it will be forced into bankruptcy and the investment that are contributed by the shareholder and investor will be lost. So to find out the company's debt to equity ratio, we can find it out on their balance sheet. And the formula to count is total liabilities divided by the total shareholders equity. Okay, so the third one, we have net profit margin ratio. The net profit margin ratios tells you how much money the company make with every $1 revenue they have. Because revenue doesn't equals to profit. When a revenue comes in, they still have to pay out all the expenses and liabilities before they can calculate their net profit. So companies with a higher net profit margins are actually they offer less risk for the investor and shareholder because they are more unlikely to go out of business and bankruptcy. So companies with a higher net profit margins, they actually can offer better benefits, and hence as a shareholder you will be rewarded as more dividend as well. So it's very important to determine a company financial health by using net profit margin ratio. And the fourth one, we have ROE, returns on equity ratio. It is one of the most important way to determine the profitability of a company that you want to invest. The ROE reveals how much the company profits in comparison to how many capital the investor or shareholder has put in. In a simple version, it reveals how much profit a company earns with the investor or the shareholders' money. So it's very important for you as an investor to look out the ROE, returns on equity, before you put your initial capital on a firm, because it will tell you how the company is doing compared to how much the previous shareholder has put in their money with. So you can have a tracking history to help you to make a better investment decision. And the fifth one, we have dividend payout ratio. The percentage of profit distributed as a dividend to the investor are called as dividend payout ratio. Some of the company, they actually have a company policy to pay out certain percentage or certain amount of profit to the company, and that is their own dividend payout ratio. Like REITs in Malaysia, real estate investment trust, they actually have a regulations to regulate them to pay out at least 80% of the profit to the investor. So the REITs in Malaysia, they have an 80% dividend payout ratio, for example. Okay, so here's the extra one. I didn't put it on the board because it's not exactly a ratio, it's just a measures that I use a lot when it comes to analyze stocks. It's dividend yield. Dividend yield is a percentage of the company's annual dividend that paid out to the investor compared to the share price. So the higher dividend yield, the better dividend you will get. So if you are an income investor or a cash flow investor, pay very close attention to the dividend yield because it will determine how much percentage of the dividend you get every year. Actually, when it comes to measures or determines the value of a stock, it's so much measurements and there's so much ratio you can use. This is just 5 simple ratios that I use frequently. So do let me know if you want to know more about ratios and the measurements to analyze a stocks. So I hope you like this video, and please like this video and subscribe my channel if you like to see more video like this. Have a good day and happy investing.